I think we could see the dollar fall to 75, 70, maybe 65. Understanding what's happening with the dollar might be the most important thing you could do. Like, it seems crazy seeing gold go from 2,000 to 3,300, but I think this is the retail enthusiasm is what pushes it to 4,000 or 5,000.
And I think you said it best when you said things are unusual and weird right now. It's interesting that you say that we were already heading towards a correction in March, and your systems indicated that before the real turmoil hit.
People don't really think about currencies when they invest.
And, maybe this time is different, maybe it's not. I do think that... Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas, and I'm honored to be joined today by Brett Eversole, who is the lead editor of the True Wealth franchise at the leading financially independent research firm in the country, Stansberry Research. Brett is lead editor for True Wealth Systems, and Daily Wealth, and he has the honor of working with the legendary Dr. 𝗁𝗂𝗂𝗃𝗏 for years. So, Brett, thank you for joining me today. I'm very much looking forward to our conversation.
Yeah, my pleasure, Dana. It's really exciting to be here and chat with you. I always love talking to you. I get so many insights about the gold market, which is something that I track, not as closely as you, but definitely like to keep my eye on. And so thank you for having me. I'm looking forward to chatting.
Well, thank you, Brett. You follow all markets, so we're looking forward to hearing your insights on what's happening in this, what I'm increasingly calling these terrified markets, not tariff with an A, not with an E, although sometimes it's both. So let's get a bigger picture on the economy right now. Where do you see the U.S. economy, the trajectory going right now? And, a lot of us follow the bigger macro fundamentals of employment, GDP, inflation, interest rates, debt, deficits. What matters the most to you in those specific areas? And where do you see the U.S. economy right now? And where do you think we're headed over the next 3 to 6 months?
Sure. Well, I think it's important to start that conversation, not with where we're going, but where we kind of were before these tariff announcements came out a couple of weeks ago. I think the economy was actually in a pretty incredible spot at the start of this year. Unemployment was very low. Household balance sheets were in very good shape. Consumer spending is at all-time highs. These are all the sorts of things that you would expect out of a booming, robust economy. And if you look, like, our growth over 23 and 24 in real terms was fantastic, especially when you compare it to places like Europe or Japan that effectively had no growth coming out of the pandemic. So I think it's important to understand where the U.S. economy was when we look where it might go going forward, because where you are is going to determine how painful the shock that's hitting the market could potentially be. And obviously, this new tariff regime is a massive shock. I know there are a lot of folks that are, I would say, antsy about what's going to happen next and what the next announcement is going to be and what's that going to mean for the overall economy and for their portfolios and things like that. What I would say is that I think it's really hard to do analysis when things can change tomorrow or in an hour or in 5 minutes, over Twitter. So it's tough to do that kind of deep analysis. You can try to, but I think it's a relatively kind of a fool's errand to really go down those things. So in my view, I don't take a lot of time trying to figure out exactly what's going to happen next and then what are the exact downstream consequences going to be. I think when you think about what is happening in the economy and how do you gauge that, the most important thing, period, to me, is unemployment. If people have jobs, they are going to keep spending money, and the U.S. is a services-based economy. So if people are out spending money, then the U.S. economy is going to do just fine. This is what really got people, or what people got wrong in 2022. In 2022, it was the most obvious recession that actually never happened. I think at one point, Bloomberg economists had a 100% probability on a recession happening. Throughout 2022, we had the highest inflation in 40 years, but there was not layoffs. No one really lost their jobs. We had sparse amounts in hyper-specific fields, like in technology and places like that. But overall, nobody lost their jobs. When people don't lose their jobs, they don't really change their spending habits. And if the U.S. economy is a services-based economy, which it is, it's going to be fine as long as people are spending. So to me, an uptick in unemployment is really the thing that will jump off the page and tell me, oh, this is going poorly. And obviously that's a rearward looking indicator. But I think when it comes to the economy, you don't have to know exactly where things are going. If you get it directionally right, then you're going to know what to do with your investments. So I think unemployment is kind of the most important thing. The other thing that you can watch for to get a feel for whether that unemployment could be going poorly is I like to look at interest rate spreads in the bond market. Specifically, I like to look at high yield spreads. So this is simply the difference in interest rates between a high yield bond, which is the riskiest part of the bond market, versus risk-free treasury bonds. So in normal times, there is a relatively typical, call it 3 to 4% interest rate differential between high yield bonds and riskless government bonds. Anytime we've had an economic crisis since this data has been tracked, you see a massive spike in these high yield interest rate spreads. So you'll see them go from a low rate or go up very quickly. Now, we have seen that happen over the last few weeks. So the high yield spread was around 3%, I think in early March, and it's gotten to around 4.5, 4.6% today. So we've seen a big spike in the high yield spread, which to me is relatively concerning. This is the kind of thing that to me is like I wouldn't call it a glaring red light for the economy and for investors yet, but it's definitely a yellow light that you really, really need to pay attention to. Historically, a spike over around 5% is when you're almost certain, not guaranteed, but almost certainly going to get a recession going forward. We have seen some times where that has happened in specific markets. We saw it in 2015 and 2016 because the energy business in the US was blowing up and you saw a blowout that didn't lead to a recession. But generally speaking, that high yield spread is going to give you kind of an early warning sign that the economy could be entering a rough patch. And we have kind of a yellow light today, but that's something I'll be watching very closely, that and employment data, to see kind of where we are and how this big complicated this grenade we threw on the US economy, how it's going to actually shake out, because you can do really deep analysis, but at the end of the day, nobody really knows. So to me, it's kind of wait and see and let the data tell the story.
So employment matters quite a bit in your eyes. I recently
Yeah.
interviewed Danielle DiMartino Booth, who is a macroeconomist, and she thinks the unemployment rate could reach 4.9% by September. Do you have any thoughts on that? She really thinks that there's a margin squeeze in corporate profits, and that the biggest way that corporations are going to be able to deal with the higher input costs is to cut costs, and the most effective way to cut costs is to cut jobs. So that is
Yeah.
what she's scared of. What are your thoughts on that?
I mean, that's not something that I would say I don't track that super closely. But I do think that makes a lot of sense. What we actually saw margins increase in 2022 and 2023 during that period of massive inflation. So corporate America essentially passed all of their inflationary costs and then a little bit more on to consumers. So if tariffs are going to increase costs to, at the corporate level, companies will want to pass 100% or more of that on to their consumers, but it's kind of unclear today whether that'll be possible given the massive price increases we saw just a couple of years ago. So I think there is a bit of logic where probably two things are going to happen. You're going to see some margin compression at the corporate level, and then also you're going to see a little bit of those costs pass on. But then also, I think the idea that you're going to see some layoffs and cost cutting measures, that probably makes a lot of sense. And whether we get to 4.9% or not, that's a pretty high rate given where we are right now. But that kind of thing is possible. I think if we get to 4.9%, then the actual number is less relevant. At that point, we're definitely in a recession, and you can kind of throw out the non-recessionary playbook at that point and kind of figure out what to do from there.
Yeah, her point was that once this train kind of gets started, it's hard to stop it, and it tends to magnify itself, which is the point she was making.
Yeah.
So you're much more data dependent on a monthly basis then, looking at these numbers and how you see things.
Yeah, I wouldn't even say on a monthly basis. I would say we need to look at like multi-month trends of what's going on. Most economic data is very noisy. And so you really want to put it on a trend and figure out is this an anomalous data point that we're getting, or is this the start of or the continuation of a trend that's already going? So if that sort of thing is happening, that's really what you want to watch for. But the month to month, the week to week, a lot of these economic data points, they're fun to talk about. They're just not that useful. And you get so many revisions and things like that I think I find if you want to know what's going on in the economy, just look at the stock market because it's forward looking and the economic data is by definition rearward looking. So it's not that it doesn't have value, but the market does a pretty darn good job of pricing in what it expects to happen. It's not always right, but it's always got that forward looking as opposed to the rearward looking of most of that economic data, if that makes sense.
Oh, it makes perfect sense. And right now, the stock market's been really taking a hit.
Yeah.
It's been very knee jerky. It's very emotional. Now, you tend to look at like you said, the bigger macro trends, right? And I believe you follow, is it a 10-month average that you like to
Yeah.
follow?
Yeah. I mean, there's a lot of ways to kind of skin a cat, if you will, as far as tracking trends. But for me, you could either use a 10-month moving average, which is just the average of the last 10 monthly closes, or you could use a 200-day, if you want to use daily data, moving average. These work out to be about the same time period. And you're just averaging the last either 10 months or 200 days worth of data and figuring out what the average price over that period of time was. If the market's above that level, we would call that an uptrend. If the market is below that level, that's a downtrend. Now, if you just do very simple analysis, stocks tend to keep going up when they are going up, and they tend to keep going down when they are going down. Now, people, I think, intuitively have a problem with trends because number one, they sound a little too simple and too good to be true. And then also definitionally, the market's going to peak when it's in an uptrend. And definitionally, the market is going to bottom when it's in a downtrend. So it feels like this is a bad system to track or think about. But in reality, the most of the market's move doesn't happen at the very top or at the very bottom. It happens all those in between periods. And when the market's in an uptrend, when it's above that long-term moving average, it tends to keep going up and you get better forward going performance. When it's below that average and you're in a downtrend, you get poor forward going performance. So to me, the trend is really the thing. Like if the markets are going up, then you kind of have free reign to go out and find ideas and buy. When the market's going down, you really need to change your approach to investing because the environment is not too risky to do anything, but it's different when the market's going down versus when it's going up. And it's a riskier environment that you need to understand kind of the ring that you're walking into when you think about going to buy something.
Interesting. So you have put together with Dr. 𝘁𝗿𝗄 True Wealth Systems, which I think goes back, what, 120 years worth of data?
Yeah, I'm not sure how far back the most is. Yeah, we tried to, it was really an exercise in finding historical series when we started it out because Steve wanted to take the approach of, we don't want to figure out what's worked over the last 5 years. We want to figure out what's worked over the last 50 years for as many things as we possibly can. And, finding certain data series going back 20 years is easy. Finding them back 50 or 70 years becomes more difficult. So
Right.
we put all that together though, and tried to build things that have worked over extended as long as we possibly can periods of time.
So how does True Wealth Systems help you in the current environment where we're so volatile and knee jerky? And have we seen a trend reversal in stocks? Did stocks peak in late November or early January? Because the major indices are all off about 10% right now, give or take, a tweet by the president.
Yeah. Yeah. I mean, there's no question about it that we are not in the same kind of market uptrend that we were 2 months ago. We are definitely in a market downtrend right now. That was actually true even before the tariff announcements in early April. So our systems use monthly data to track trends across dozens of sectors and global markets. But for the US, our system actually moved to sell mode on March 31st, based on the volatility and because we were in a correction even before the tariff announcement came out. So our system moved the US market to sell mode at the end of March, even before the tariff stuff came out. So there's no question that the broad trend essentially around the world is down right now. I think what's interesting is that in the few days that happened after the tariffs were announced and we saw massive volatility, there were a lot of individual things that happened in that period that don't guarantee that we're at a bottom, but they are very much bottoming type behavior. So I've written about a bunch of these in the last few weeks. One of them is that the market fell 10.5% over a 2-day stretch. So it was the Thursday and Friday after the announcements came out. That might not sound like anything, but that's actually an incredibly rare occurrence to have a 10% plus decline over 2 days. So going back to 1950, that's happened 3 other times. One was after Black Monday in 1987. One was in November of 2008, which wasn't the actual bottom, but it was darn close. And then one was in March of 2020, actually about a week before the eventual bottom in March 2020. So that doesn't tell us with certainty that the bottom is in, but this is bottoming type behavior. We saw another instance like this the day that the tariffs were put on hold and the market went up 9.5%. So that kind of thing, a plus 9.5% day, does not happen very often. You actually have to get a few more instances. I ran the numbers on 8% plus days. Those happened in, again, 1987, November of 2008, and then a couple of times in March 2020. So it's not a guarantee that the bottom's in, but this is bottoming type behavior. We also saw a massive VIX spike. The VIX was the highest it's ever been outside of March 2020 and in the November, December area in 2008. And again, these are bottoming type signals. What's interesting this time, and it does feel very different to me this time than those instances, although every time feels different, is that based on, like you say, like a tweet or a press conference out of the White House, things could all change dramatically. So I think it's hard to put too much stock in these kind of indicators and say they definitely tell us with certainty that the bottom is in. But if we don't get massive change announcements, I think that this is bottoming type behavior. Now, obviously, the other side of that coin is that are these going to turn into economic turmoil and contraction in earnings and contraction in multiples and spiral into a long-term, I don't know if all that stuff's going to play out. It might play out, it might not. But to me, this is bottoming type behavior. And if it holds up, if we don't see a massive decline in price and we get a slow kind of grind forward, when the market does tick higher, I think you have an incredible opportunity to buy. We're not there yet, and things could go against that, but that's kind of the way I see it over the next few months.
Well, one of the things that I love and respect about you is you're very level-headed. You take the emotion out of it, and you trust your systems.
Yeah.
You advise people take a trailing stop so that they mitigate losses by getting stopped out. And do you do the same thing I guess you do that with profits on the way up. You put a trailing stop in if you're gaining as well. So you cover that both ways. And, on the Daily Wealth, coincidentally or not, on April 9th, you said that, because there'd been such a bloodbath, that was creating opportunity, which is a part of your contrarian philosophy, which I love, buy when there's blood in the streets. And that was the day that President Trump rescinded the 90-day reciprocal tariffs, and there was that huge relief rally.
Yeah.
So it's interesting that you say that we were already in a corrective, kind of heading towards a correction in March, and your systems indicated that before the real turmoil hit. So if people are following you, they might have stayed off of that mine when it blew up, right? Yeah. And you also in March suggested that people look outside of the U.S. into some of the emerging markets. So would you elaborate a little bit on why you see value outside of the U.S. and some of the other places, and perhaps where do you see value today?
Yeah, absolutely. I want to go back to one thing you said, though, because I think it's really important. You say that I try to take the emotion out of things, and I take that as a high compliment because, so thank you. I think the biggest mistake that most investors make is allowing emotions to control their investments. And this is such an easy thing to do. Investing is a very bizarre activity. And what I mean by that is with almost anything in the world that you do, the harder you try, the better you'll get and the better your results will be. If you want to play basketball, you're not going to get better at basketball by thinking about it. You're going to get better at basketball by going outside, learning how to dribble, learning how to shoot. That is true for basically every single thing that you do in the world. Investing is not like that. The harder you try, the more you do. There's not a guarantee, but you are probably going to end up with worse results. And so in emotional times, what people end up thinking is that, well, I need to act. There's a lot of stuff going on right now, and their emotional brain gets going. They start to get worried, and they think they need to do something. Usually, when you have a downward, a bout of volatility like we've lived through, the something that people end up doing is moving to cash. They can't take the pain. They're worried about what's going to happen. They allow their mind to kind of catastrophize into the worst possible outcome, becoming so obvious and completely certain. and they just can't take it, so they move to cash. This happened to my uncle actually in 2009. Um, it was after the bottom, but he just couldn't take, this was the summer of 2009. He couldn't take all the news, the recession. While the market had already bottomed, the recession was at its worst. And he ended up moving a multi-million-dollar portfolio out of stocks, essentially selling at the bottom, and then moving all of that into cash, where he sat for about a decade and missed on probably 400 or 500% of returns that would have made up all of his losses and then a lot more. And that kind of situation is not uncommon. I hate that that's true, but that kind of situation is just not uncommon. And it's what happens when you let emotions drive your investing philosophy. So to me, the most important thing before you put any money to work is to understand what you're doing, and what your goal is. Know why you're buying and know what will have to happen for you to sell. Some people like to take fundamental views and, if the company misses earnings or XYZ, then I'm going to sell. I would just prefer to put stops on everything. And then if a thing falls 25%, well, we're going to sell and move on. And maybe you really like that idea still, but you're never going to let a very small loss grow into a catastrophic loss. And when times like this come around, you don't really have to worry. It's not fun. Losing money is never fun, but if prices fall and you hit a stop, then you're going to sell. And you don't really have to think about it. You don't have to worry about, well, what if the market goes down 75%? Because you're going to have sold when it was down 20 or 25%. So I think coming up with a system for yourself to get emotions out of your investing is the most important thing. So sorry, that was a big tangent, but I think that's just like one of the most important things for investors. You had asked about investing outside the US. Is that right?
Yes. Where do you see value in? You said you saw some value in emerging markets. So can you
Yeah.
elaborate on that a little bit, please?
Yeah. So this is, we talked a little bit offline before we hit record on this, but this is kind of investing outside the US to me is a story not about the investments outside the US, but more a story about the US dollar. So the US dollar just broke down to a 3-year low. It peaked in, I think, September of 2022, and it's kind of meandered lower ever since. People don't really think about currencies when they invest, but if you are a US investor buying things outside the US, understanding what's happening with the dollar might be the most important thing you could do. And I say that because the dollar has a history of these big long-term bull and bear markets where it will go essentially only up for 7 or 8 years, and then it will essentially only go down for another 70 or 8 years. And on those down drafts, the dollar can fall by as much as 40 or 50%. On the updrafts, it can rise by 60 to 100%. So my belief is that we saw what I would call a secular dollar peak in late 2022. I think it was around around 115. So we just broke below 100. And I think that we're in the middle of a secular dollar bear market. Now, that is important because what that means is we've seen the dollar fall from, call it 115 to 100. Given what we've seen throughout history, I think we could see the dollar fall to 75, 70, maybe 65 from here, which is a massive decline. That does not mean that US stocks will do poorly with certainty, but it does mean that there's a massive tailwind for stocks outside of the US. So the last time we saw this kind of dollar bear market was during the 2000s. The dollar bottomed, I think, around 2001, and then peaked around it peaked around 2001 and then bottomed around 2008. I think it kind of double bottomed in 2011. So over that period, call it 2002 to 2007, US stocks doubled. They were up 120, 130%. But European stocks, for example, were up around 250%. Emerging markets were up 400 to 500%. A lot of those returns were because those economies and the stocks that were in those markets did well, but also when the dollar's falling by 40 or 50%, you've got a massive tailwind for these foreign markets. So I think that at a very high level, we're in the middle of one of these dollar secular bear markets, and that makes the opportunity in foreign markets very good. So if you look at European stocks, I like Germany as well, as they're kind of reindustrializing right now. And then emerging markets, China is kind of its own thing, but with the stimulus that's the Chinese government's running, I think that they're a good opportunity as well, especially the internet sector in China. I know a lot of people hate the idea of investing in China and always give me dirty looks and nasty notes when I talk about it, but I think there's a lot of opportunity there as well. So I think at a high level, it makes a lot of sense to put some money to work outside the US right now with that dollar setup going on. And those are some of the places at a very broad level that I think are really good opportunities.
Well, I remember back in, I guess, about 2001, the dollar, I think on the dollar index was 121, and I think it fell all the way to about 100, by 2008, if I remember correctly. And that, of course, was really good for gold,
Yeah.
which leads me to my next subject. In the True Wealth Systems in April, you said that, despite gold hitting all-time highs, gold mania still hasn't hit the U.S. yet. And, I remember back when I started the American Gold Exchange in 1998, when the gold market was bottoming at about 300 to a little under that. Then there was coordinated central bank selling that brought it down to 250. And the Washington Accord came in where they agreed they wouldn't all dump at the same time. It's stupid. But when gold went from 3 to 500, most of the participants were the believers, people like myself. And then from 500 to 7 or 800, it was mostly institutional smart money coming in, sensing the trend. And then from about 2009, when the financial crisis hit, from 1,000 to 1,900, that was when the retail public came in. So, I've read the issue, so I understand some of what you're going to say, but for the benefit of our listeners and our watchers, viewers, where do you think we are in that cycle right now? Because you said gold mania isn't here yet. And also, Basel III is going to be enacted here in the US this summer. And that has an implication for bank holdings of gold. So could you elaborate on that too, please?
Yeah, of course. So yeah, there's a lot there. I mean, so I started in this business in 2010, and I was just a young, dumb kid out of college, and I didn't know anything. And I didn't know that I didn't know anything, so it was great. But I got to Stansberry Research, and gold was just the hot thing, and it was the hot thing everywhere you looked. You watch financial television, there were "We Buy Gold" ads everywhere. You drive down the street, there's guys spinning signs that say "We buy gold" at the the local pawn shops. It was just like the biggest thing in the world. And to me, actually, what happened with gold over the next few years was very instructive to me as an kind of like one of those formative things for me that made me the investor that I am today. And I say that because when I started, it just seemed like gold was this guaranteed bet. Like it had gone up so much over the last decade. Everyone wanted to buy it. Everybody was in on it. It just made perfect sense. There was no rational reason for why it wasn't going to keep going higher. But then it crashed and it just went down and down and down and down and down and ended up falling by about 50% over 5 or 6 years. And as I was kind of going through this, I realized there's no such thing as a forever asset, especially when you're talking about things that are, non-productive, like gold is a non-productive asset. And so where you are in that cycle is actually really, really important. I would say the most important for how much money you're going to make going forward. And so gold's an interesting case because I think people expected it to hedge inflation better than it did in 2021, 22, 23. So people just kind of left it for dead. There was more exciting things. There was AI to think about. There was cryptocurrencies, and they just kind of forgot about gold. And over the last, 24 months, it went from $2,000 to $3,000 an ounce, and retail investors just aren't buying. I know that you know that, Dana, because when I spoke to you a few months ago, you were told me your phones just weren't ringing. And we kind of see that in the data as well if you look at the gold ETFs. So like GLD is the largest gold ETF. And ETFs are great because you can look at their overall share count. ETFs will create, if a lot of demand comes in, they will create shares in order to fulfill those orders. If people sell a ton of the ETF, they will liquidate shares. So the overall share count kind of gives you a glimpse of what retail investors are thinking about an investment idea. So in the case of gold, GLD's shares outstanding had fell by about a third from 2020 through the end of last year. So that tells me that retail investors just aren't buying. Well, we know who is buying, and that's central banks. So they bought over 1,000 tons of gold in 2022, 2023, and 2024. And Basel III is actually another interesting case. So what this is going to do, and it's going to go into effect this summer sometime, is it's going to change regulations for US banks so that if they hold gold, right now they have to hold it and assume that it's a very risky asset. What that means is they have to hold 50% of its value in reserves. Soon, when this goes into effect, they will not have any reserve requirements for gold. They can mark it to market and treat it as though it's cash. So that is going to, I think, create a lot of demand for gold at the banking level. We're already seeing central banks buying tons and tons of gold. But again, who are we talking about here? We're talking about big banks and we're talking about central banks. This is institutions. This is smart money. These are the folks that always end up buying at the early stages of a boom. And these folks don't buy when you're in a mania phase. Who buys when you're in a mania phase? That is the retail type investors. So that's what I walked into when I started this job in 2010. And I thought this was just normal. And what I was seeing was a retail frenzy. Um, we are definitely not at that retail frenzy stage because retail just hasn't been buying. They weren't buying throughout the last 3 or 4 years. What's interesting is that's actually starting to, the early stages, starting to reverse right now. So if we look at GLD's shares outstanding, they actually bottomed around mid 2024, and they've risen about 20% since then. Now, importantly, they're still down by maybe 25% from the 2020 high. So there's still a long way to go. And I expect that we'll probably see shares outstanding catapult past that 2020 high by the time this all gets going. But when I put it together, I think basically the only people that have been buying gold so far are smart money institutions and big banks and central banks. Retail just hasn't bought into this boom yet. But with everything down and gold up right now, I think we're going to see an explosion into that trade very soon. And that's the kind of thing that can push, like, it seems crazy seeing gold go from 2,000 to 3,300. But I think this is the kind of the retail enthusiasm is what pushes it to 4,000 or 5,000. And I think that that's very possible over the next 2 to 3 years. And so to me, we're very much in the middle innings of the gold boom where it's just shifting from that institutional buying to more towards retail type buying. And that can last for years though. I think you said that retail kind of took over in 2008 and the peak didn't happen until 2011. Is that right?
Yeah, yeah. I would tend to agree with you on this cycle that from 2000 to 2800 is more, central bank buying driving it and some institutional money. The move that we're seeing now is, I think, a little bit of a FOMO, big FOMO money, fear of missing out. Um, and I do think that especially if there is a rejection of U.S. Treasuries, which is possible in this environment because of a lack of trust in the government, that opens the door to huge, runs higher in gold. And what I always say is gold climbs a wall of worry. And throughout this big run in 2024, when we went from 2000 to 2800, there was no fear in the US marketplace. Stocks were doing well, the economy was doing well. You said at the top of our talk how well the economy was doing at the start of this year, right? Unemployment was low, profits were good, inflation was coming down. But now we've got a reason to have some fear. And that I think is part of a major shift here. Now, whether it's lasts or not, you'll know better than I will. But you're right. Our clients, for the most part, the regular clients who have not been participating, some of the larger clients have been placing some really big orders, actually, which is good for us. But I like to have as many clients participating as possible, and that's an indication that for the most part, the retail investor is still not in the market yet. But we're
Yeah.
sensing changes now.
Yeah. And I do think what you're saying about the treasury market is really important. And it's the kind of thing that could turn, it could become gasoline to the fire, is what I see. Um, what I mean by that is gold had been doing well and it had been outperforming. And when you've got something that's outperforming US stocks, basically nothing has done that for the last 15 years. So when you have that happening, you're going to see some money flow into that asset anyways. But what this is kind of a tangent, but what's interesting about the last few weeks of trading in all kinds of markets is that you saw the stock market sell off. And generally, when that happens, you see the treasury yields go down and you see things like gold go up. What happened initially is that yields went down, but then yields spiked back higher. And the dollar is crashing as well. And you would expect the dollar to go up when the market's panicking, when the stock market is panicking. So the US market is kind of trading in a weird, bizarre way right now, not like it normally should. And so if gold is kind of the last man standing, the last safe haven asset, if you will, I mean, I know people like to talk about Bitcoin as digital gold, but at the end of the day, Bitcoin is effectively trades like a highly risk on asset, which is fine, but it's not going to be the protective asset in an environment like this. So if gold is kind of the last man standing, you're going to see, I think, a lot of money flow into it. I think we've seen the start of that in recent weeks. And if we continue down this path that we are on with lots and lots of uncertainty, I think two things are going to happen. People are going to want to buy gold for the certainty and for the safety and security. And they're also going to want to take money out of the things that are not working and put it into the thing that is working. And right now, if you look around the world, effectively gold is the only thing that's going up. So I think it's going to draw a lot of assets. And again, that's kind of like gasoline, pouring gasoline on a fire of this boom that's already underway.
Yeah, it's quite interesting because usually the dollar and our treasury market becomes first choice safe haven. And gold has stepped in front of those in those last couple of weeks as first choice safe haven. Um, and I think you said it best when you said things are unusual and weird right now. And
That's certainly true.
yeah, I mean, and maybe this time is different, maybe it's not. I do think that going to what President Trump's trying to accomplish, this is just a big negotiating tactic on his part. Um, I think the big question will be, how does China react with us, and will we cooperate with them? I think if China and the U.S. can cooperate and come to an agreement that's reasonable for both sides, that could take a little steam out of this gold rally. But otherwise, there's been a reason for a lot of our trusted trading partners to have a little bit less trust in the U.S. recently because of some of our knee-jerk moves.
Yeah.
And I worry about how fundamentally that might alter things for potentially years to come. We're seeing more and more editorials along those lines in just the last week or so. So, one of the things I like about what you do fundamentally is you look for things that are cheap, hated, and in an uptrend. And gold is not cheap right now, but it has been hated, and it is in an uptrend. The other precious metals, you have any thoughts on silver, platinum, and palladium while I've got you?
Silver's not one that I really track much. I really like platinum and palladium. I think there's a big opportunity there. Palladium had this crazy run in the late 2010s and then crashed by 70 or 75%. It got just incredibly hated. The way I like to track commodity sentiment is through the Commitment of Traders report, which is a weekly report that looks at what the futures traders are doing with their money. And when these folks are all very bullish or all very bearish, it tends to be a massively contrarian signal. So in the case of palladium, these folks were the most negative they've ever been late last year. We haven't really seen prices reverse there quite as much as I would have expected, but I think palladium is a great opportunity, and I expect a similar kind of opportunity in platinum. Those two industrial metal, they're very much more industrial metals certainly than gold, and probably even more than silver. And the car market is very important to them. I think a lot of the crash that we saw in platinum and palladium was due to the kind of, I guess, the entire world getting ahead of itself with how much electric vehicles were going to take over the vehicle market. We've seen some slowdown in adoption in EVs, certainly here in the US, and I believe globally as well. And I think people are kind of waking up a little bit to the realization that we're going to need more platinum and palladium than we kind of expected 3 years ago, when it seemed like, green energy was taking over everything. So I think there's a long tail for demand for those, longer than people expected, and that's going to lead to higher prices. So yeah, I definitely like platinum and palladium, but I mean, I think the easiest, simplest opportunity right now is definitely gold. It's clean as far as that goes.
Well, I would tend to agree with you. I do think that platinum and palladium are tied to the Chinese economy. That's just
Mhm.
anecdotal on my part. I have nothing to prove that, but I've seen when the Chinese economy has been stronger, those prices have been healthier relative to gold. And right now they're trading at, a discount by a third of what
Yeah.
gold is, which is highly unusual. And I do think palladium is a better one because it's scarcer and it's used in more gasoline catalytic converters, while platinum is more diesel. So if I were to bet on one of them, I would bet on palladium first, but I think they'll both travel in tandem.
Yeah, I think so
So,
as well.
I really appreciate you taking the time to spend with me today. Give it just people a little bit of an anecdote of how much I respect your opinion and your cool headedness. I remember we were together at the Rule Symposium in the summer of 2023,
Mm.
and there was a social event that we went to and had dinner at. And I caught you a little later, and I asked you if there was going to be fallout in the banking system because of the commercial real estate issue, because a lot of the big buildings and people that have a lot of tenants in commercial real estate were being affected by work at home and also economic closures. And the concern, and then there was a lot of hype about it.
Yeah.
Is this gonna translate into another banking crisis? And I flat out asked you that question, and you said no. But fundamentally, you said the reason is because most of the commercial real estate is uh, loaned by regional banks, and they tend to be more isolated than connected to the bigger system. So there's going to be some problems with some regional banks individually, but it will never transfer into the system as a whole. And I left that dinner going, oh, that was nice. I can sleep a little easier now. And that's how I feel when I look at your research and the time and effort you put into what you do. And I know that you have integrity and heart in everything that you publish and all of your recommendations, which is why I'm honored to know you, to be friends with you, and to be a subscriber. I'm an Alliance member, and I look forward to seeing you every year at the annual investment conference. We'll be in October in Las Vegas. I think it's October 20th and 22nd again. And
Sounds great.
if I get lucky, I'll have you sit next to me at lunch one day. So, Brett, I can't thank you enough for coming on and sharing your insights with us. They're invaluable. And I'm sure my clients and our viewers will find them invaluable as well. So, thank you so much for being here and helping us to navigate all this craziness that's happening in the markets right
Yeah, it's my pleasure, Dana. Thank you for the kind words, and yeah, I definitely appreciate our friendship as well. And thank you so much for having me. It's been a lot of fun. Hopefully, we can do it again sometime.
now. Well, I might just make that call if that's okay with you.
Absolutely.
All right. Thanks, Brett. Good to see
Thank
you.
you. Bye.